Monetary policy is the process by which the monetary authority of a country controls the supply of money. This is used to promote economic stability for those in that country. In the U.S., the Federal Reserve uses monetary policy to maintain economic stability through open market operations, changing the discount rate, and altering the reserve ratio. First, let's define the types of money that are present within the United States. M0 is cash and coins. M1 includes M0 plus checkable deposits such as checking accounts. M2 includes M0, M1, and non-checkable accounts such as saving accounts, money market deposit accounts, and money market mutual funds. M3 includes M0, M1, and M2 plus large time deposits. As mentioned previously, the Federal Reserve, or the Fed, is in charge of monetary policy, specifically the Board of Governors, which consists of 7 members appointed by the President. The activities of the Board of Governors is directed to the 12 Federal Reserve banks, which control the rest of the nation's banks. The easiest way for the Fed to change the money supply in the country is through open market operations. On a scale of how badly the U.S. needs an economic fix, open market operations would be like using a Band-Aid. In this situation, the Fed buys or sells securities to banks with the intention of either increasing or decreasing the money supply. When the money supply needs to be increased in the country, the Fed can simply buy more securities from the banks, which increases the amount of money banks have to loan out. This increases the money supply and lowers the interest rates. When the money supply needs to be decreased in the country, the Fed can simply sell more securities to the banks, which decreases the amount of money the banks have to loan out. This in turn decreases the money supply and increases interest rates. If open market operations are not enough, the second thing the Fed would do to stabilize the economy is changing the discount rate. If open market operations was like putting a Band-Aid on a cut, changing the discount rate is like fixing a broken bone. The discount rate is the rate that the Federal Reserve banks charge for loans to commercial banks. If the country is in need of a greater money supply or an expansionary policy, the Fed can decrease the discount rate, which means banks can more easily borrow money from the Federal Reserve banks, which in turn increases the money supply and lowers the interest rates. If the country is in need of a contracted money supply or a contractionary policy, the Fed can increase the discount rate, which means banks have a harder time borrowing money from the Federal Reserve banks, which in turn decreases the money supply and increases the interest rates. Changing the reserve ratio is the last thing the Fed would do if open market operations and changing the discount rate were not enough. If open market operations were like putting on a Band-Aid and changing the discount rate is like fixing a broken bone, changing the reserve requirement is like open heart surgery. The reserve ratio is the percent banks' reserves must keep on deposit with the Federal Reserve Bank or as vault cash. Since banks lend their excess reserves, a system of banks will magnify original excess reserves into a larger amount of new demand deposit money, causing the money supply to grow by more than the original excess reserves. To establish this amount of money, a multiplier is used. The money supply is equal to 1 over the reserve ratio. For example, if someone deposited $100 into a bank and the required reserve ratio was 0.2, then the bank's excess reserves would be increased by $80. And since the money multiplier is 1 over 0.2, which is 5, the money supply would be increased by 80 times 5, 400. If an expansionary policy is needed, decreasing the reserve ratio increases banks' excess reserves, causing the money supply to increase. If a contractionary policy is needed, increasing the reserve ratio decreases banks' excess reserves, causing the money supply to decrease. During a recession, unemployment is over its equilibrium rate of 5% and CPI is under its equilibrium rate of 3%. In this situation, unemployment is at 8% and CPI is at 2%. The problem during a recessionary gap is that the demand has decreased due to a shortage of real GDP. To fix this problem, aggregate demand has to shift to the right to increase GDP and price levels. To fix this recessionary problem through monetary policy, the Fed has to choose one of its 3 expansionary options: buying securities, lowering the discount rate, or decreasing the Federal Reserve ratio. When one of these 3 things occur, the money supply increases and shifts to the right. As a result, the interest rates decrease, making it easier for people to borrow money. During a time of inflation, unemployment is under its equilibrium rate of 5% and CPI is over its equilibrium rate of 3%. In this situation, unemployment is at 4% and CPI is at 5%. The problem during an inflationary gap is that aggregate demand has increased due to an influx of real GDP. To fix this problem, aggregate demand has to shift to the left to decrease GDP and price levels. To fix this inflationary problem through monetary policy, the Fed has to choose one of its three contractionary options: sell securities, increase the discount rate, or increase the Federal Reserve ratio. When one of these three things occur, the money supply decreases and shifts to the left. As a result, the interest rates increase, making it harder for people to borrow money. During stagflation, both unemployment and CPI are over their equilibrium points. In this situation, unemployment is at 8% and CPI is at 2%. The problem during a stagflationary gap is that the supply has decreased and therefore price levels and GDP are both low. To fix this problem, aggregate demand has to shift to the right to increase GDP, or price levels have to go down. To fix this stagflationary problem through monetary policy, the Fed has to choose one of its three expansionary options or one of its three contractionary options. Both may fix the problem. This slide will focus on the expansionary fix. The Fed can buy securities, decrease the discount rate, or decrease the Federal Reserve ratio. When one of these three things occur, the money supply increases and shifts to the left. As a result, the interest rates decrease, making it easier for people to borrow money. This will make people want to buy more and create more jobs, eventually shifting the supply back to the right. To fix this stagflationary problem through monetary contractionary policy, the Fed has to choose one of its three contractionary options: sell securities, increase the discount rate, or increase the Federal Reserve ratio. When one of these three things occur, the money supply decreases and shifts to the left. As a result, the interest rate increases, making it harder for people to borrow money. Therefore, price levels will drop and people will start buying more, putting more into the economy, which will help increase GDP.